Let's go ahead and get started. The title of our webcast today is Organic Growth, 4 Key Strategies to Succeed. My name is Jared Roy. I'm in the business development unit here. I'm a consultant with MarshBerry, and my role is that of new business development. So I'm out there meeting with new potential relationships to MarshBerry, agency owners. The commonality is they all want to increase their agency's performance, and my job is to help connect them to that end through the power of our peer networks. I also have with me my colleague and counterpart, Josh Morgan.
That's right. I cover the western portion of the United States. I'm essentially Jared's counterpart, and as he mentioned, our primary role is to find and recruit great agencies into our peer networking groups. As he mentioned, today's presentation will be on organic growth. It's a very important subject. It's a bright and shiny day here in Cleveland, and the fact that you've all joined us is just kind of underscores the point how important this subject is to agency owners and executives. So to get into an agenda for today's presentation, for those of you who have not been on a MarshBerry webinar or have never seen us talk, we'll talk briefly about MarshBerry, who we are, what we do, where we came from. Then we'll get into some background statistics on organic growth, 4 ways to improve your own individual strategy, a review, and then some Q&A and discussion. Happy to take your questions. So MarshBerry, as a company, we were founded in 1981. We have 4 offices. We're headquartered in Cleveland, Ohio, privately held. We have actually perpetuated our ownership internally with 15 individual shareholders, so we practice what we preach there. Our clientele includes the whole spectrum of the insurance distribution system. Our primary clientele, however, are insurance agencies. We do business with credit unions, banks, insurance companies, etc., be it a speaking engagement or something else. Our entire goal at MarshBerry is really to help agencies learn, improve, and realize their fullest business potential. We consider ourselves sort of a womb-to-tomb consulting firm. We structure what we do into 4 buckets: information services, management consulting, exchange networks, and merger and acquisition advisory. We're fairly well known for our merger and acquisition advisory, but it only makes up about 50% of our business. The rest is really management consulting, information services, and to dig into one of the buckets in specific, our exchange networks, we've been managing exchange networks for about 15 years. We have 6 networks in total with over 186 partners across the United States, Canada, and Puerto Rico. Now, during today's presentation, I'm going to talk and mention our task network throughout the presentation because we use members of our task network from a statistical standpoint to benchmark other agencies. What task is, it's essentially a collection of agencies who meet twice per year to discuss organic growth and the best practices surrounding it. If you would like to continue our conversation around organic growth, we would invite you to join us as a guest at our next meeting. As I mentioned, essentially agencies group together in small groups and share best practices amongst each other, problem solve in a small group fashion. We also offer a state of the industry presentation, a general session focused on healthcare reform, as well as educational breakout sessions on employee recognition, the future of technology in the industry, compensation, and operations. So when you see task mentioned in this presentation, that is what we mean when we say the task network. So organic growth background and statistics. How can we grow? There are a few growth drivers inside of an agency. the first of which is acquired growth when you buy a book or another agency. The second is organic growth, where you can add a new product to the mix, you can increase your price, or you can sell more existing products and services. The one that we will focus on today is selling more existing products and services, because ultimately that is what you have direct control over. And so for the purposes of this presentation, we will focus on selling more existing products and services. So from a growth statistic standpoint, if we were actually showing you 2010 numbers, the average agency would be negative, slightly negative. Those numbers have turned positive, but they are still somewhat low. As you can see, there's still a large disparity between an average agency and a high growth agency, and it's particularly concerning for many agencies due to many of them going through perpetuation within their agency. As many of you know, in order for perpetuation to work, growth just has to happen. It is extraordinarily important for internal perpetuation to succeed. And so with only a 2.3% organic growth, perpetuation is still exceedingly difficult. And so many of you will aspire to be in that top 25% high growth agency, or considered a high growth agency, and you aspire to be 11.5 and beyond. And that's why you're here. And so to talk about the solution, Jared will introduce some of our solutions for you today.
Thanks, Josh. So Josh had a chance to go over some of the background statistics for you with regards to organic growth. I'm going to start the process of getting into the solution. We've categorized our solution to the challenge of organic growth into 4 main areas of assessment. We'll talk about all 4 of these today. Organizational infrastructure. What does your company look like? How is it structured? Differentiation. We talk about this quite a bit. What differentiates you from your competition? Proactive sales, and we'll get into a little more about this and also talk about some sales management techniques. And one of the most important things to lead our agencies into the future, producer investment. First area we'll talk about today is organizational infrastructure, and it is so important to have your organization structured in the right way to promote new business sales. And Josh mentioned our task network. These are agencies that are constantly trying to institute a sales culture in their organization. So I would challenge you to ask yourself, what does your organizational chart look like? Does it look like this on the left, with the CEO and department heads reporting up to the CEOs, division leaders, and then employees falling in line with a top-down sales mentality? Or do you have top producing producers running the show, so to speak? The main takeaway here is that we encourage you to have your organization set up in the right way to succeed. We're going to give you some data. This is the first of many data points that we'll talk about today, and this is taken from our extensive database of producers and the amount of new business that each type of producer is writing on an annual basis. And we always use this chart when we're categorizing producers into these different stratifications and book analysis and sales management assessments. So if you look at the 4 categories we have there, new, senior, executive, and $1 million. The new producer has been in the business less than 3 years. Senior producer, this is a veteran in the industry, small book. Executive producer, also a veteran, has a medium-sized book above 500 but below $1 million. And the $1 million producer is obviously a tenured producer with a $1 million book. So I'm not going to go into all the details of this spreadsheet that we presented you with, but one thing that you can do is take a look at your own production staff and physically plot them with a dot on this chart where they fall. You know what category they fall in, and then based on what their average new business sales is, you can just plug them right in the spot where they fit. Are they from 40 to 60%, which would make them average? Or do they fall into the upper echelon in the top 20% or even the lower 20%? And the bottom 20% would mean we need to work on increasing their production and help them get up to that average production level, which we see there under all producers is $67,450. The one thing I do want to point out is I have this section highlighted under senior producer. And the reason is these are, again, they've been in the industry over 3 years, but have under $500,000 book. And consistently, they are underperforming with respect to their potential. And you can see even the new producer on the 40 to 60 as well as the top 25%, they're outperforming the senior producers, the new ones are, in all those categories as you go up to above average. So the issue with senior producers is, potentially maybe they have slowed down, maybe they don't want to work so hard, but it's our job to make sure that they continue to be motivated and they're set up to succeed to write new business. As this continues with organizational infrastructure, we want to make sure that your structure promotes new business sales, and we'll get into more of this later, but provide the resources, tools, and all the right metrics to drive growth in your agency. The next set of data that we'll talk about revolves around the new business minimum requirement. Here's another question. How many agencies on the call have a new business minimum? That's a revenue dollar amount that a producer needs to hit to retain the producer title. It's a very important question. Some of the agencies that we talk to have this in place. Some may have it where it's not high enough. I want to bring your attention to the picture in the bottom right-hand corner of the screen there. And this is a drill sergeant giving instructions at maybe a fitness boot camp. If you were to join the military, there is a requirement. You have to do a certain amount of sit-ups, push-ups, chin-ups, run the mile under a certain amount of time. And if you don't, you simply are not allowed to join. So we're not suggesting that you run your agency like a drill sergeant, only that you set and enforce minimum expectations that will promote a focus on new business. The data that we presented here for you shows the difference between the average agency, our task partners, and that subsection of our task network that are high growth. And you can see the high growth agencies have the highest new business minimum, and these are across all geographies, rural, urban, $83,000 in new business, and subsequently, because of the focus on growth, 61% of all producers, senior executive and million-dollar producers are achieving that new business minimum. So our suggestion here is that you raise the bar and expect more out of your producers. The next chart we'll talk about is the minimum account threshold. How many of you out there have a minimum account threshold? If you don't know what that is, it's a set dollar amount below which new accounts are not paid commission to a producer. So anything that doesn't go to the house is considered above that minimum account threshold. We've been often asked, where should I set that new business minimum account threshold? And it's not an exact science. This varies by agency, but a method that we've found, if you put the metrics to the test, is represented in this chart. New business dollars as a percentage of prior year commissions and fees is on the left, and your target account ratio is along the bottom. If you know what your average account size is, which you should, if you don't, it's a very simple calculation. We suggest that you calculate 70% of that average account size, and that's what you assign as your minimum account threshold. That will promote, in this, according to this study, a 20% new business percentage, which is exactly what Josh mentioned the high growth agencies are at, 19%. So this will encourage your producers to go after larger accounts and will effectively raise your average account size to allow you to write more new business every year. We're just talking about helping your producers focus on the right things. This is a chart that helps you realize and coach your producers as to what they can do to help grow their book. So as producers continue along in their career, the goal is to grow their book while maintaining profitability and continue to write new business every year. So this chart looks complicated, but we're basically talking about an upward trajectory where we factor in the three items that we've analyzed: average account size on the left, average book of business along the bottom, and average number of accounts on the right. So what we've found with all the books that we've analyzed is there is a correlation between these three things, and you want your producers to remain as close to the line as possible as they grow their book. So if they fall to the left of this line, they need to write more accounts. They have a pretty good average account size, growing their book, just write more accounts. If they're to the right of the line, they need to increase their average account size. They have a ton of small accounts and have a big book, and what you don't want is that they hit capacity. So if they can increase their average account size, then it'll get them back to the line and in the process of growing their book of business. We also suggest that you give your producers the tools they need to succeed. And I used the military analogy once, and my colleague Josh here was in the Marines, and when he would go out to battle and in the various missions that they charged him with, the Marines is, in our opinion, one of the best branches of service out there, and they always had the best equipment, the best weapons, the best tools, and what we're suggesting is that you do the same for your producers. Arm them to do battle, so to speak. So think about this. I mean, we're in a war with our competition. So we've given you some data on some tools that some of the agencies that we work with, and some are in our task network. We've compared average versus high growth, and these three things across the board, the high growth agencies are doing much better and offering more to their producers. So if you take a look at the first one, differentiation platform, almost double the amount of high growth agencies versus average have a defined differentiation platform, and Josh will talk about that in a minute. The next is pipeline management system. A significant higher amount of high growth agencies have a pipeline management system for their producers to help track their pipelines. And this goes without saying, a sophisticated service staff, again, almost double the amount of high growth agencies are providing their producers with an excellent sophisticated service staff.
So Jared mentioned differentiation as a way to arm your producers as they go out and compete in the competitive landscape. It's a difficult subject, and one that we could probably do a week-long series of webinars on. And so I am going to simplify it dramatically based upon an article that MarshBerry wrote a few years back. These stats here are really to underscore the point that the market that you all are going toward is mainly below 500 employees and below. In fact, 98% of your customers will be below that 500 employee threshold. And the competition is tremendous. It's very stiff, and differentiation is something that insurance agencies are notoriously bad at. In fact, I would challenge you to go on to the website of some of your competitors and see what they write. They all say that they have sophisticated service staffs. They all say that customer service is number one. They all say that they are talk about the benefits of dealing with an insurance agency. The bottom line is everyone is saying the same thing, and I would greatly encourage you to take a hard look at what you are doing. And so I'd like to talk about really a format to help you get through the formative stage of at least establishing what could be your differentiation platform. And again, this is taken directly from an article that we wrote at MarshBerry a few years back. There's 4 steps that we came up with to differentiate yourself from an incumbent. And the first of which is to know what makes you different. Now, I mentioned the customer service, that you're an independent agent, that you've been in the industry for 100 years, you're a family-owned corporation. Everyone says the same thing. What really makes you different? Do you specialize in underwater space vehicles? Do you do something out of the ordinary that no one else does? Whatever the case may be, know what makes you different. Secondly, know how to articulate it, whether it's a 60-second elevator pitch or something that everyone can know and appreciate. Third, you must be able to show it. So if everyone in your company knows this elevator pitch, they can go out and uniformly spread the message, which goes into number 4, ask others to share it. You have to have this elevator pitch so that others can easily share it. They can easily comprehend and share your how prolific you are at writing insurance for underwater space vehicles or whatever the case may be. So if you're interested in reading this article, it's approximately 3 to 4 pages. I'd be happy to email it to you after. Just request that we'll leave our email address up toward the end. So we talked about our task network earlier, and this is a piece of data that has come out of our task network founders group. And we tracked those that established a differentiation platform over the last several years. And we found that if you look at the retention of the top 20% of their accounts, they've increased by roughly a point on average. And if you think about this over a 10-year period, that is a lot of money. That's a lot of account saving going on. And the price of setting up a differentiation platform is certainly worth the price of admission if this could be a potential result. And I think you would all agree. To move into proactive sales, and what I really mean when I say proactive sales are some sales management techniques or some quick looks to see if you are setting up an appropriate carrot and stick approach, as we like to refer to it at MarshBerry. Now, we mentioned the 20% prior year book growth target in as far as new business for the year. If that is your established target, and let's say that your current split for new versus renewal is at 40-25, which we recommend here at MarshBerry. We view it as sort of the industry average. Do you offer a carrot to your producers? Could you offer a carrot to your producers where if they wrote 20% above that 20% prior year book number, that you could increase their new business percentage back to $1 retroactively for the current year to 45%. If they wrote 30%, if they exceeded their target by 30%, you could increase it to 50. If you increase it to 40, you can increase it by 55 or up to 55. The whole entire point of this is to get producers lusting, have an insatiable appetite for new new business. As we know, coming out of the last soft market, the difficult economy, what got agencies through that time period was writing new business. And so we should keep up those good habits that we had to put into place back then, or maybe if you didn't establish those good habits back then, maybe now is the time so you can benefit from the coming good market or the coming hard market that's potentially occurring. So to get into the stick, we talked about the carrot, now let's talk about the stick. A difficult subject to bring up with producers, but establishing a minimum target of 15% of their prior year book. If you establish this as a target, and again we assume that the current split is 40-25, if you were to miss that minimum in year 1, your renewal percentage would be dropped to 20. If you were to miss it in the second year, your renewal percentage would be dropped to 15. If you were to do it 3 years in a row, a serious conversation needs to be had as to whether or not this person is an actual producer, or if they are better suited to be an account representative, or if there's even a seat on the bus for them in your agency. So I know that this is a difficult topic and it's easy to talk about. The execution is much more difficult, but I would encourage you to take a strong look at a carrot and stick approach, because we've seen many agencies employ this very effectively, and it was always difficult to do. But I tell you what, if you asked every single one of them across the line now, if they were glad they did it, they would all say they are. So to move into a planning model, you can sit down with Joe's sales producer for next year, how you want him to go about his business and building his book of business. This is a potential model that you can use. This is part of today's presentation. We're going to send everyone a copy of today's presentation. You could potentially model your planning model after this. What I like the most, if in section 3, establishing an activity worksheet where you transfer new business goals into activity goals. And a quick example of this would be if your new business goal were, say, $100,000 in new commission, and you knew that it took, your closing ratio was 1 out of 10, so you needed 100 appointments. You knew that for every closed piece of business, you needed 100 phone calls. So again, you can kind of do the math and draw a line backwards in the sand as to what you need to do from an activity standpoint to get yourself where you need to be at the end of the year. Jared broadcast this chart earlier. This is blank. It will be part of this presentation. We encourage you to chart where your producers sit in regards to the line and help explain to Susie, Timmy, and Bobby which way they need to move to help them more effectively grow their book. We also love to see wall charts posted inside agencies. This is just an example. It's a way to create competition amongst producers and make people feel bad for not producing, which is something that needs to happen, but also reward people with recognition for those that are doing well. So we always like to see this in an agency. If you'd like to take this and use it as your own, go for it. As far as cross-selling goes, Jared and I, we've been in a number of agency offices over the last several years, well over 100. They all say they're great at cross-selling, but none of them track it. And so I would challenge you to track your cross-selling, establish a bonus or minimum territory, and post this alongside your other scorecard, your leaderboard, if you will. Jared?
Thanks, Josh. Last section we'll talk about here is producer investment. And as Josh mentioned, over the last couple years, we have visited and talked to hundreds of agency owners, and by and large, this is an area where the industry just simply has a challenge. We need to bring new producers into the industry to take our business to the next generation. I talk to agency owners all the time about this. You know, what got us here is not going to get us there. So we need new young folks that are, as some of my agency owners like to tell me, that are smarter than they are to help their agency succeed. So we've got a few things here to talk about that will help you understand why this is important and maybe give you some tips to help lead you in the right direction. First, we'll present some data. This looks at the average weighted book of business by age. And as you can see, the average agency is on the left and the high growth agency is on the right. And when you compare the commissions and fees that are controlled by producers over 50 years old, you'll see that a significant higher number is with the average agency controlled over 50 year producers over 50 years old, 51% versus 38%. So that tells you that the high growth agency has a more targeted, focused approach on bringing in younger producers. And not just that, let's look at the 31 to 40 category. Average 12%, 31 to 40 in the high growth agency, producers age 31 to 40 are bringing in over 26% of the revenue. So that's significant. Now that's total revenue. Let's look at new business. The numbers basically correlate the same. The new business generated by producers in the average agency over 50 years, 47% versus only 32% in the high growth. Again, just emphasizes the point that the high growth agencies out there are dedicated to bringing in young folks that can take our agencies to the next level and into the next generation. I want to point out again, just this 31 to 40 category, these guys are the workhorses and gals of the high growth agency. Over 30% of the new business brought in, the highest of any other age group, producers already. This is very compelling. What we've done is we've put together a quick model of a compensation plan that we use in our recruiting service. And as Josh mentioned on differentiation, we could spend an hour just on this topic, and there may still be areas that we haven't covered yet. So if you don't know already, MarshBerry has a recruiting service that we offer. We'd be glad to talk to you about it offline. But in essence, we're happy to give you the model, share it with you. You can move forward with this initiative on your own, or you can engage us to help you with this effort. At any rate, we'll present this model to you today as part of the presentation. And the main thing to remember when you're putting a compensation model together is that it needs to offer upside to top candidates so that you can motivate those folks, as well as protecting your firm from any downside that exists. We suggest that starts at 60, and again, this is an average that could vary based on where you're at, and declines from 40 to 20, and by the fourth year, the producer is on a straight commission, and that producer is paid commission from the first dollar. That's important because, as Josh mentioned, we want these guys to be hungry for new business and really motivated to go after that new commission, and this gives them a taste of what the lifestyle is like. Their base pay is validated by new business appointments. So to look at an example of this, beginning in month 3, the first couple months they'll be getting licensed and do an orientation of your agency. The base pay is $5K per month that must be earned, or their base drops the following month. Let's assume we want 60K in production for a 60K base. Also assume that our average account size is 5,000. To make the math easy, we need 12 accounts to earn the base. 12 times 5 is 60K. If we assume the closing ratio is 50%, we'll need 24 deals or opportunities in the pipeline to hit that 60K. If we also use the mentor model, which we do recommend, then we need to double that, because the mentor will split every closed account 50-50 with this new producer. So instead of 24, we'll need 48. So if we divide that by 12 months in the year, we need 4. Only gets 3, then their following month compensation will be $3,750, not $5K. If they only get 2, it'd be $2,500. If they don't get any, it'll be 0. So what we find that this effectively does is encourages the right activities very early on. And we say this all the time, you want to find out as soon as you can if that dog can hunt. And one thing that we've also found is if a new producer has trouble setting a new business appointment, you can be reasonably certain that they will not be a successful insurance producer long term. So that's one advantage. The other advantage is this also limits the downside to your firm. I've talked to a lot of agency owners who have brought in new producers that maybe haven't worked out, and the upside of that is they did bring new business in while they were there, which usually still is at the firm. And in this model, if they're not getting appointments, they're not earning their salary. So again, content portion of our presentation at the beginning, this webinar was brought to you by our Total Agency Sales Culture Task Network. Grow is the theme. That meeting is coming up in Denver in the fall, September as a matter of fact, and if you'd like to join us, feel free to reach out to us, and we'd be happy to have a conversation with you about the qualifications and whether it would be a fit for your agency to attend. There's some information on the screen as well. Our contact info is there. If you'd like a copy of the article, let us know. But at this time, we do have a few minutes. We're happy to leave the line open for some questions. So if you have a question, remember to hit *6 to unmute your line. And at this time, let's open